I'm Lily Litwin, president of St. Michael's Hospital Foundation, and I'm pleased to welcome you to Create Your Legacy, Estate Planning 101. Today, you'll learn more about the benefits of estate planning and the tax advantages of leaving a gift to your charity of choice. You will learn about new estate laws from two of Canada's premier estate lawyers. As legal professionals, they're highly qualified to advise on estate planning. But first, I'd like to speak briefly about the idea of creating a legacy. We know too many people put off estate planning. It's a human reaction to a very tough topic. But the past year and everything we've witnessed and suffered has inspired many of us to ask some big questions and to think differently. How do I protect myself and those I love? How do I alleviate the suffering of people in need? And what can I do to make the world more fair and more just now and in the future? These are just some of the questions our world-class teams at St. Michael's Hospital and Providence Healthcare tackle every single day. When you create your legacy, you help them find answers. And in the process, you protect your loved ones, you comfort those in need, and you create new possibilities for living healthier, longer lives. Now, in the spirit of legacy, I would like to take time for a land acknowledgement. As we gather today, we acknowledge this sacred land on which St. Michael's operates. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Peton nations, the Seneca, and most recently, the Mississaugas of the Credit First Nation. The territory was the subject of the Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and the Confederacy of the Ojibwa and allied nations to peacefully share and care for the resources around the Great Lakes. Today, the meeting place of Toronto is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our nations. Now, let's hear from our two guest experts who will give you guidance on estate planning and update you on the most recent changes to the law. Elena Hoffstein is a leading mind in charity and not-for-profit law. She addresses all aspects of estate planning and advises charities and donors on tax-effective charitable giving. Elena has received the Ontario Bar Association's Award of Excellence in Trusts and Estates and a recipient of Lexpert's Zenith Award. And for those of you who don't know, Elena's beloved husband, Dr. Hoffstein, is a doctor at St. Michael's, well-respected and well-loved. And Brittany Sudd's practice focuses on estates, trusts, and related taxation law. She is qualified as a trust and estate practitioner by the Society of Trust and Estate Practitioners and holds a certificate in elder law from Osgood Professional Development. Please join me in a very warm virtual welcome for Elena and Brittany.
Thank you, Lily. Hi, everyone. I'm Elena Hoffstein, an estate planning lawyer with Miller Thompson. I'm looking forward to sharing our insights during today's Create Your Legacy Estate Planning 101 event with my colleague, Brittany Sudd. Before we get started, here are some housekeeping items. You'll find a Q&A chat box on your screen. Throughout the duration of our session today, if you think of a question for the speakers, just type it into the chat box. We'll hold all questions for the Q&A at the end of our event, and we'll pose as many questions as we can to the speakers. Please note, this is a public event and all questions submitted will be visible to our guests and attendees. If you're experiencing any technical difficulties, click the Tech Support FAQ or Tech Support chat at the bottom of your screen, and one of our techs will help you. After the event, you will be sent a few survey questions. We would be very grateful if you could submit your answers. Today's webinar is being recorded. You'll receive a link to rewatch the session after the event. We welcome you to revisit the content yourself and share it with friends, family, and colleagues. Now, let's get started with our presentation.
Thank you, Elena, and good afternoon, everyone. Thank you for joining our presentation. So today, I want to start off with a little statistic, and that is some of you may or may not know that more than 50% of Canadians do not have a signed will. And that is a pretty scary number. So today we're here to talk to you about estate planning, why it's important to have a will, what happens if you pass away without one. We'll discuss some issues to consider when you're making your will. We'll talk about income taxes, probate fees. We'll also discuss powers of attorney, another important element of your estate plan. We'll touch on some of the recent changes to estate planning laws in Ontario and when you should be reviewing and updating your estate plan. So what is estate planning? Well, estate planning is more than just about having a will. There's two main aspects. First, it's about deciding how you want to transfer your assets to the next generation or to whomever you wish to benefit. And second, it's about preserving and protecting your property before the transfer and in some cases after the transfer occurs. As a result, there are three main objectives that people have when thinking about their estate plan. They include the preservation and protection of assets during lifetime, the orderly and efficient transfer of assets to beneficiaries during lifetime and on death in a manner which minimizes income taxes and other administrative fees, and the continued preservation of property once it's been transferred to the beneficiaries. A well-drawn will is the most essential element of an estate plan. It's flexible. For the most part, you can decide who's to inherit your assets, at what time, under what circumstances. It's revocable. As long as you have the testamentary capacity, the mental capacity to make a will, you can change or update your will at any time prior to death. And the will also speaks from the date of death. So if you make your will today and you pass away in a number of years from now, it'll encompass all of your assets that you acquire between the time you make your will and the time that you pass away. It's also easier for your loved ones that you leave behind. You're able to convey your wishes to them, and it'll help reduce administrative hassle and expense. It also could avoid the potential for litigation, having a will and setting out what your intentions are. And having a will allows you to provide for charitable giving, to provide for gifts to charities by way of legacy, cash amounts, or specific gifts of property, or setting up funds for charity in your will. In Ontario, the Succession Law Reform Act, our legislation, sets out a scheme of distribution if you were to pass away without a will. And dying without a will is known as dying intestate. So here we've just set out a little chart for you that goes through different circumstances and what happens to your assets or your property if you were to pass away without a will, depending on your marital status, if you have children at the time, depending on how many children you have and the amount of your assets. So for example, I'll just briefly mention that if you're married but you don't have any children and you don't have a will, everything would be left to your spouse. But if you're married and you do have children and you have more than this preferential share amount of $350,000, then your spouse will receive this preferential amount of $350,000. And then the balance, anything above that, is divided between your spouse and children. And it will depend, the division will depend on how many children you have. I will just mention that this preferential share amount of $350,000 was recently increased from $200,000. And that is for people that pass away on or after March 1st, 2021, that it's now $350,000. For estates of individuals who died before March 1st, 2021, the preferential share amount was $200,000. Some other things to point out is that when we're talking about married spouses, we're talking about legally married spouses, so not common law partners or spouses. And if a spouse was separated and not legally divorced, they would still be considered married for this purpose. However, our laws have recently changed, and as of January 1st, 2022, this will no longer be the case. And so if a spouse is separated but not divorced, a separated spouse will not be entitled to inherit on an intestacy. And the legislation sets out what it means to be considered separated. So a spouse is considered to be separated if before the person's death, they lived separate and apart as a result of the breakdown of their marriage for at least a period of 3 years. If the period immediately prior to death, they entered into an agreement that's a valid separation agreement, or if a court made an order with respect to their rights and obligations in the settlement of their affairs arising from the breakdown of their marriage, or if a family arbitration award was made with respect to the rights and obligations in the settlement of their affairs arising from the breakdown of their marriage. And at the time of the person's death, they were living separate and apart as a result of the breakdown of their marriage. Some other things to point out is that when we talk about children, we are not talking about stepchildren. So stepchildren are not included. That might be, a reason why you want to make a will. Adopted children are included, and children born outside of marriage are also included. But it's important to keep in mind that without a will, the interests of any minor children, so those under 18, would be required to be paid into court until the individual turns 18, at which time they would receive their entire inheritance outright. As well, without a will, you have no control, of course, over the assets that specific individuals receive. So these are just some reasons why you would want to make a will. If the scheme of distribution is inappropriate for most people. So moving on to some limits on our testamentary freedom. So testamentary freedom is the freedom to deal with your property on death in the manner in which you choose. But there are various limitations on our testamentary freedom. And so we've set out a number of them here. The first one being testamentary capacity, which I briefly mentioned earlier in terms of being able to revoke or change your will as long as you have the testamentary capacity, the mental capacity to do so. So a will must be the free and voluntary expression of a mentally capable person. You have to be at least 18 years old to make a will. There are a few exceptions, but generally you have to be at least 18 years old. And the test for capacity is that you understand the nature and effect of a will. You understand what assets you own. You understand what assets you're giving away in your will and to whom. And you know who might be expected to inherit something under your will, such as a spouse or minor children or a disabled child. And if anyone's being excluded, you understand whether that person could make a claim against your estate. And things like mental illness, undue influence, insane delusions, duress, and fraud may all make a will invalid. So it's important to work with a professional to assist you with preparing your will and making sure that all the formalities are met in terms of how to execute the will and who may be witnesses to the will. And we'll touch on that a bit later. Another limitation on our testamentary freedom is dependence relief. So an individual has an obligation to ensure that his or her dependents are adequately provided for on death. Dependents include dependent children, grandchildren, spouses, common law partners, former spouses where payments are required to be made pursuant to a separation agreement or a divorce decree, and parents, grandparents, and siblings that you're actually supporting during your lifetime. And if this obligation is not met in the will, a dependent would have the right to bring an application to court for relief under our legislation, the Succession Law Reform Act. And a determination as to whether an order for support is to be made and the amount to be awarded is going to be within the discretion of the court. And a third limitation on our testamentary freedom is pursuant to the Family Law Act. So when one married spouse dies, if they, through their will, leave their surviving spouse less than the surviving spouse would have been entitled to under the Family Law Act upon a separation or divorce, then the surviving spouse is entitled to elect to receive the same entitlements that they would receive on separation or divorce, as opposed to the benefits that they are provided for in the will. And this election takes place within the first 6 months after the death of one of the spouses. And they can elect to take equalization of net family property under the Family Law Act, or elect to receive what they're given under the will. And if they choose if they choose an equalization of net family property, then the gifts to the surviving spouse in the will are revoked, and the will is read as if the surviving spouse predeceased the other spouse. Some other limitations on testamentary freedom include where property is subject to a joint tenancy with right of survivorship. That property would not be able to be given away by will because it would pass automatically on the death of one of the joint tenants to the surviving joint tenant by operation of law. And this happens outside of the estate, outside of the will of the first joint tenant to pass. Joint tenancy is different than a tenancy in common situation where property might be owned by 2 or more individuals and each owns a certain percentage, and what their interest goes according to their will and will pass through their estate. But with a joint tenancy, it doesn't. It automatically passes to the surviving joint owner. Lastly, if there's a cohabitation agreement or a marriage contract or a shareholders agreement, those would trump and take precedent to how you're dealing with your assets in your will. So your property might be subject to certain obligations you have under those agreements. So when meeting with advisors, we give advice and guidance on how to properly structure an estate plan. And these are just some of the things that we see and we look for in terms of what complicates an estate plan. So some of the assets that may make an estate plan more complex is where there's ownership of private corporate shares, foreign assets that you may own, assets that are co-owned with individuals other than a spouse. And certain circumstances that lead to more complex planning include blended families where there's children from prior marriages, dependents with special needs, family members that are located in other jurisdictions, and foreign citizenship of the person that's making the will, their spouse, and or their beneficiaries. So these are some of the issues now that we consider when you're making an estate plan. So number one would be, who do you want to appoint as your executor and trustee? And the executor is the person that's going to be administering your estate after you're gone. And the trustee would be appointed to manage any trusts that you set up in your will. They don't need to be the same person, but they often are. And you want to think about how many executors and trustees you should be appointing. Typically, it would be between 1 and 4 or 5 people. Anything beyond that makes decisions extremely difficult. So you also want to think about how decisions should be made. Should they be made unanimously? Or if you're having 3 or more executors, do you want to allow for majority decision making? You can do all sorts of things. You would also think about appointing an alternate person if the first person you name can't act for whatever reason, they pass away or they're incapable or unwilling or unable to act as your executor at the time. Who do you appoint? So this question comes up a lot. Sometimes it's pretty straightforward, and it's this, a surviving spouse and then adult children. But other times it's more complicated, and sometimes people want to appoint a trust company or their lawyer or accountant, a trusted advisor to the family. There's also, you can appoint a friend or a relative. It doesn't have to be anyone related to you, but you have to consider who's going to take on this role, because it's not really, it's not an honor to take on this job. It's a burden and it's a lot of work. Of course, people can, whoever you do choose, can appoint advisors to help them in terms of decision making and in terms of investment decisions and things like that. And, you hire an accountant to help with filing tax returns, but ultimately the decision is left to who you do appoint as the executor. It's also recommended that you don't appoint someone outside of Canada. Sometimes this causes problems where people have their family all outside of Canada, and they don't know who to appoint. So there are specific issues with appointing U.S. persons. They are required to have certain reporting and disclosure obligations to the IRS, for example, for being the executor of a foreign estate if you appoint someone that's in the U.S. So we don't typically recommend that. And there's definitely workarounds as well. Executors are also entitled to compensation. They're entitled to reasonable compensation unless you specify in the will a specific dollar amount or percentage amount. But they are entitled for being compensated for the work that they're doing. And the next important consideration is how you're going to dispose of your assets in your will. So really, there's 2 ways to do this. It's either outright, as an outright gift, or in trust. And when you leave your assets outright to a beneficiary, the beneficiary will have complete control over the management of the assets distributed to them. And on their death, the assets will pass in accordance with their will. Or if they die without a will, then in accordance with the intestacy laws, which we briefly discussed earlier. The second option is to dispose of your assets by way of a trust. And a trust is a relationship whereby one or more individuals, known as the trustees, hold legal title to property for the benefit of other individuals, known as the beneficiaries. So if you create a trust in your will, the trustees are given the authority to manage property on behalf of and for the benefit of the beneficiaries, who may, for example, they're not capable of handling assets themselves. The beneficiary will not have control over the management of the assets, and the trustee will assume the responsibility for managing the assets until the assets are distributed to the beneficiary. Commonly, these are set up for minor children or grandchildren, where there's individuals who are spendthrifts and they don't want an inheritance to go directly to them. Or disabled individuals who might be receiving government benefits, and you don't want to put them offside of receiving ODSP, for example. Another common example is where there's a second marriage, and you want to make sure that you're providing partly for your second spouse, but also for your children of a prior marriage. So trusts are set up in that way to split how the income and capital is dealt with. lots of options to how you want to transfer your property in terms of maintaining some sort of control after you're gone by way of a trust. Other things to consider is if you have children that are specifically minor children, you want to make a will so that you can name and appoint a guardian and custodian of your children if both of the parents pass away. And this is a temporary appointment, so it's a 90-day appointment, and the person that you name in your will would have to apply to court within the 90 days after death to become named the permanent guardian and custodian of children. And as well, trusts, as I said, are often set up for minor children who you want to receive their inheritance at a later age than 18, where assets would be held in court until a child turns 18 if there's no trust for them. Often 18 is too young to receive an inheritance, so you want to delay the age and have them receive distributions at later ages, such as age 25, 30, 35, things like that. Some other issues to consider: foreign assets. If you own assets in other jurisdictions, particularly real estate, it usually makes sense to have a separate will with respect to those assets because real estate is governed by the law of the jurisdiction where it's located. And having assets in foreign jurisdictions may subject your estate to taxes imposed by that jurisdiction. So it's best to speak with a lawyer and advisor in the jurisdiction where you own assets. Cottage property. This often is a point of contention in families, and you have to think about who uses the cottage. Should there be an option for one of the beneficiaries to acquire it as part of their share of your estate? Should it be held in trust for successive generations to use? Should it be sold to avoid any fighting over how it would be shared? Cottages have a lot of sentimental value in families, and so often it ends up being a source of tension among siblings when both parents pass away. There's some things to think about with that. As well, personal effects. You would want to consider whether there's any personal or household items of sentimental value to anyone that you want to specifically give to someone in your will. It also might be appropriate to just set out a letter, a non-binding letter or memorandum outside of your will that sets out your wishes as to who you want to receive, some of your jewelry or artwork or things like that. And this way you maintain the flexibility of being able to update that list from time to time and not having to change your will every time you want to make a change to that document. And while it's, if it's outside the will, technically, not legally binding, usually the executor will follow the wishes of the deceased. Charitable giving. So there are certain tax advantages to charitable giving on death. If you leave a gift in your will to charity, you'll get a charitable donation tax credit for the amount of the donation, and that can be used to offset income taxes that you or your estate owe depending on when the gift is made. You could leave a legacy in your will of a specific dollar amount or a percentage of your estate to charity. Alternatively, you could set up a donor-advised fund during lifetime and contribute to it on your death. You could also designate a charity as the beneficiary of a registered plan or life insurance policy. Donating publicly traded securities to charity has even greater benefits as well, as you're not taxed on any accrued gains on those shares. So I'm now going to pass it over to Elena to talk about income taxes on death.
Thank you, Brittany. When we talk about estate planning with our clients, there are three main tax considerations that we discuss depending on their application. The first one is Canadian income tax. The second is non-Canadian income tax, often U.S. estate tax, because of how and the extent to which it could apply, which I'll talk about in a minute. And the third is a very popular one for those of us who live in Ontario, called probate tax, which I'll also dwell on in a minute. So just coming back to Canadian income tax. Canadian income tax is applicable to anyone and everyone who is resident in Canada. And if you are a resident of Canada, applies to your worldwide estate. So in Canada, unlike the US, there is no estate or inheritance tax on the gross value of one's estate, but rather there is a deemed disposition of your capital property, such as real estate and investments on death, in order to bring the accrued gains into income and make them taxable. There's an artificial sale event, which is why it's called a deemed disposition event, because there's no real sale of your assets, but you're deemed to have disposed of them at the time of your death. And if the assets have gone up in value since you acquired them, then you'll have what you call a capital gain, 50% of which is taxable and has to be reported on your tax return, subject to certain exceptions, which I'm going to talk about in a minute. RRSPs and RIFs are one exception. The full value of an RSP or RIF at the date of death is includable as income, taxable income in the year of death, unless it's subject to certain exceptions. Life insurance proceeds are tax exempt, so that there's a lot of planning that we can do with life insurance. When there are ways to minimize the capital gain tax if you engage in estate planning, such as estate freezes and insurance opportunities, these are beyond the scope of this presentation, but I mention them because these are topics that you likely will want to discuss with your advisors or your lawyers. Now, talking about other exceptions to the general rule, if you transfer assets such as RSPs or other assets to your spouse, either outright or in a trust, there's a rollover of these assets at their cost base, and any gains are not realized or taxable until the spouse dies or the trust or the spouse disposes of the property. So it's a deferral of tax rather than an elimination of the tax, but a deferral is almost as good as an elimination. If you're transferring assets to a trust for your spouse, there are certain requirements for the terms of the trust in order to qualify for the rollover. A principal residence exemption may partially or fully shelter the gain on a principal residence. And it's important to remember that if you have several residences that could qualify as a principal residence, including residences outside of Canada, you can only have one that qualifies for the principal residence exemption. So that's Canadian income tax in a nutshell. The other tax that we talk about is the possible application of U.S. estate tax, but tax in foreign jurisdictions, but very often it's U.S. estate tax that arises if there is a connection to the U.S. or a beneficiary who's a U.S. citizen or a resident. These rules are quite complicated, so I'll just give a very quick overview of them. U.S. estate tax could apply if you have what is called a U.S. situs property. So that includes U.S. real estate, or if you have securities in your portfolio that are shares of U.S. companies, these also qualify as U.S. situs property, and U.S. can impose their tax on that, and could lead to potential double tax in the death scenario. The other one where the U.S. tax regime could apply is if you or your relatives are U.S. persons. If someone is born in the U.S., they are a U.S. person unless they've given up their citizenship. But the other one that is very important that people often don't realize is if they're born to a U.S. parent. So these are persons who are what we call hidden U.S. persons, because often they don't realize that they are U.S. persons, and it's only when someone asks the question, well, is your parent a U.S. person, that could transfer U.S. citizenship to you inadvertently, that's when sometimes these facts come out. The third tax that I want to talk about is probate tax. So this is a tax that is a subject of a great deal of conversation in provinces such as Ontario and British Columbia, where the probate tax is quite high. And in Ontario, the probate tax is 1.5% or $15,000 per every $1 million of value going through a will. And just to compare that with Quebec, which charges $64 to get probate. So these are very relevant questions for those of us who are lucky enough to live in Ontario. So the first question that we always get asked is, well, what is probate? So probate is evidence from the court of authority of an executor that is named in a will. So I, as a lawyer, would say to you, an executor obtains his or her authority from the will itself and not the certificate of appointment of an estate trustee, which is what a court gives. But what the probate certificate confirms is it confirms to third parties that the person appointed as the executor has the legal authority to administer the estate. So the authority comes from the will, but sometimes often third parties want evidence of that authority, and that's where probate comes in. So why and when is it needed? First of all, it's needed if there's no will, if you die intestate, which Brittany went through some of the intestacy rules with you. This is another reason to do a will and not to die without one, is to avoid probate tax and have it planned. If there is a will, but there's no executor alive, or there is an executor alive but not willing to act, then you have to go to court to get the authority to act. Transferring real estate is troublesome because most real estate in Ontario is under the Land Titles Act, and subject to a few exceptions, the Land Titles Act requires probate in order to transfer title. And there are workarounds, but it's important to know what the rule is. The most important and most often faced problem is relating to financial institutions. So if you've got an investment portfolio or bank accounts of any value with financial institutions, or RSPs without beneficiaries, very often you'll find the financial institution requiring a probated will to confirm the authenticity of the fact that it's the last will and testament. So probate fees are based on the gross value of personal property that is wherever it's located. So for example, shares or stock portfolio anywhere in the world, or real property, but only real property in the province. There's no deduction for debts except for mortgages on real property. And as I said, $15,000 for every $1 million worth of assets is definitely worth looking at in terms of planning around it, because that is not an expense that an estate needs to have if you can avoid it. So what are reduction techniques? Reduction techniques in relation to reducing or avoiding probate tax really is a very asset-specific exercise, and the solutions are based on the different assets. So one is joint ownership. Brittany mentioned joint ownership earlier in her discussions. A lot of people think that, well, I'll just put my assets jointly with my children or jointly with my spouse. You need to be careful because it's not a perfect solution and often leads to other problems, because if you're putting assets in joint ownership with your children, for example, there is a disposition for tax purposes of that portion that you're sharing with your children. Also, it exposes those assets to the marital issues of your children and their other possible problems that they might be having. So that one is a solution, but you need to think through the potentials for problems. Beneficiary designations on vehicles such as life insurance, RSPs, and TFSAs are reduction techniques for those assets. Having more than one will. When you have assets, for example, a family business, shares of a family business, very often those types of assets go into a separate will that is dealt with without the necessity for probate. And so probate tax would only be paid in those circumstances with respect to wills that cover other types of assets. Alter ego trusts and joint partner trusts are becoming more popular in Ontario. They are trusts that are set up during lifetime. You have to be over 65 years of age to benefit from this type of planning, but they are a way of keeping assets outside of an estate for probate tax purposes, and are a way of resolving, avoiding probate tax on assets such as investment assets, and could become an alternative to a will. and to powers of attorney. So I'm just going to now quickly, we have very little time left. I'm quickly going to go into the last portion of our discussion, which deals with powers of attorney. So wills speak from death, but what happens if you are not able to look after your affairs prior to your death, or look after your health? So this is where powers of attorney come in. There are two types of powers of attorney. One is a financial power of attorney or property power of attorney, and the other one is a personal care power of attorney. So quickly dealing with financial powers of attorney, these are powers of attorney that generally are general and apply to all of your assets, or could be limited in terms of the purpose and duration of the power of attorney. But generally people have general powers of attorney, and you have to be careful when you're being asked by your financial institution to also have a limited power of attorney for a particular bank account, that you're not revoking the general power of attorney that you may have put in place. In addition to that, if you spend any time outside of Canada in another jurisdiction, it might be important to get a power of attorney in respect of the jurisdiction in which you're spending a lot of time, such as different states in the United States, if you have bank accounts there or have real estate there. If you don't have a financial power of attorney, then the result is, if you become incompetent, then your family members have to go to court and get a committeeship or a guardianship, which could be expensive and has other consequences, expenses on an ongoing basis in terms of reporting to the court on how they've been administered. Turning to personal care powers of attorney, these are powers of attorney that allow someone to make healthcare decisions for you if you can't make them for yourself. Brittany, do you want to change the PowerPoint to the next one? So these are the types of decisions that can be made by a personal care power of attorney. Just going to the next one. One point that a lot of people ask about is, well, what about, go to the next one. What people ask about is, to what extent can I put my own personal requirements into a personal care power of attorney? And the prior PowerPoint said that you can, so that you can give instructions to your powers of attorney with respect to what you want done. But many people ask, well, what about MAID? What about medical decisions about dying? You cannot put anything into personal care power of attorney that gives instructions to your power of attorney about medical assistance in dying, because the legislation doesn't permit that. And but other than that, you can put other instructions in. And that PowerPoint that you see in front of you explains why it's not possible to put it in a power of attorney. And that's because the legislation requires the person who wants the medical assistance to confirm their instructions several times during the process.
Okay, thanks, Elena. So yeah, just with the last few minutes, there has been a number of changes in Ontario with passing of several new legislation. Some notable points just to mention is that virtual witnessing of wills and powers of attorney has been made a permanent law. When the pandemic began last year, the government allowed for a temporary order that allowed for witnessing wills and powers of attorney virtually, because the law has always been that you have to have the person, for example, making the will with two independent witnesses in person at the same time, signing the documents and witnessing. But of course, with the physical distancing measures in place, we've been allowed to do virtual witnessing, and that has now been passed into law permanently. So that's good news. Some other important changes that have been made is that it has always been in Ontario that marriage revokes a will unless the will was made in contemplation of marriage. And that has caused a lot of problems for people. Most people don't even know that. And beginning in January 21st, 2022, that provision of the Succession Law Reform Act has been repealed. So wills will no longer revoke, wills will no longer be revoked on a marriage. I mentioned earlier, there's been some changes with separated spouses, and Lastly, I just want to touch on, so we've left some slides here for you, but I just want to touch on when to review your estate plan. And typically we recommend every 3 to 5 years, or more frequently if there's been major life changes, such as an increase in assets or new family members that are born, or change in executor and trustee residency, for example, or change in marital status, things like that. So we just leave you now with a little chart here. And the death rate remains steady at 100%. Death is certain. So we urge you to take the time to plan for it. Thank you, everyone, for listening to our presentation. And we'll now open it up for your questions. So the first question that has come in here is whether a lawyer is required to prepare a will. So the answer to that is no. It's possible to actually draft or write your own will. It's called a holograph will, and a holograph will is entirely in the handwriting of the person making the will, known as the testator. And that will has different formality requirements than a typically drafted typed will. And we caution against using holograph wills because a lot of the times they don't encompass all of the assets that the individual has, or you forget important considerations to include, such as who you're going to appoint as your executor. You might just list you want certain belongings to go to certain individuals, but usually they're not fulsome. And so we caution against writing your own will. There are also online wills and will kits as well. I know someone asked about comments on making an online will. Again, we don't typically recommend doing that. It is best to speak with a lawyer, and you either meet with a lawyer and get your will prepared in a proper manner from the outset, or risk having your family members, after you're gone, having to hire a lawyer and litigate and clean up the mess that you've left. So we do recommend visiting a lawyer and a professional to assist with preparing your will, to ensure that everything is done properly and addressed properly. Another question that's come in here is about whether a Canadian will would invalidate a will that has been left previously in another country. So it is possible to have 2 or more wills coexist. They just have to be drafted in a manner that basically says that there is more than just this one will. And so as long as it's drafted properly, it is possible to have 2 or more wills, and they won't invalidate the other that was drafted.
Also, I think it's important that the wills say specifically that they don't revoke whatever prior will that is supposed to coexist. And it's often a good idea to have a will in a separate jurisdiction, especially if the assets in that other jurisdiction are real estate, because real estate has very local legal requirements in terms of transferring them, like who the executors should be, and so on. So often it's a good idea to have more than one will, but you've got to be careful, as Brittany said, to make sure they coexist with each other, or if there are more than 2 with one another.
And someone also asked here, I see June Oliver asked about whether foreign property is included in the probate calculation. So real estate in jurisdictions outside of Ontario are not included in the calculation for probate tax or probate fees, but personal property and located anywhere in the world would be included in that calculation for probate.
And that includes like a stock portfolio that you may have in a different province or in a different country. That still would be includable because that's considered personal property, right?
Someone else asked here about, Ian asked, does the spousal equalization only apply to married spouses, or does it apply to common law spouses as well? So the spousal equalization only applies to married spouses. Common law spouses have other rights, such as spousal support. They might have a spousal support claim, and I mentioned that earlier in the presentation, where and that would apply where a common law or legally married spouse feels that they weren't left adequately, assets adequately in the will of their deceased spouse. They might have a claim for spousal support against the estate of the deceased spouse. But for equalization of net family property, that is only for married spouses. Some other questions that have come in here. So who should set up a trust? Any guidelines? Say a single family with one child, does it make sense to set up a trust? So there's many different reasons to set up trusts, and trusts, I believe the question here is about setting up a trust in your will. And if there's a child, even one child that is, for example, a minor, so under the age of 18, it would make sense to set up a trust in your will for that child, because minors cannot hold assets outright in their own name. So you would want to have someone manage and administer their trust on behalf of the minor until they reach a certain age that you can set out in your will. And, we did, I think, mention during the presentation as well, various reasons that people set up trusts. So it's not only for minors. Second marriages is also another common place where we would set up trusts for the second spouse, where there's children of a first marriage as well. And so, someone may want to leave certain assets to their surviving second spouse, but also make sure that there's going to be something left for their children of a prior marriage. So that might be another reason. Another question that has come in: does giving to a charitable organization only offset estate tax, or are there any other tax benefits to leaving a legacy gift? So just to be clear, so there's no actual estate tax in Canada. We have the probate tax, and then we have capital gains tax, which is an income tax. So there's no estate or inheritance tax like some other jurisdictions have. And so when leaving a gift to charity in your will, for example, your estate would receive a charitable donation tax credit that could be used to offset some income tax or capital gains tax that your estate is liable for. And typically the largest tax exposure is in the year of death when someone passes away, because at that time there is a deemed disposition for tax purposes. So any assets that someone owned during their lifetime, any appreciation on those assets from the time they acquired them to the time they pass away, there will be a tax consequence, and there will be a potentially a capital gain. If there's been a significant appreciation, then there's going to be a large tax exposure to the estate. So leaving funds to charity would assist with offsetting or reducing that tax liability of the estate. Okay. What else has come in here? So there was also some questions about where there's children or beneficiary in the US or other foreign jurisdictions. So the first thing to say on that is that you should be getting advice in the other jurisdiction. There are jurisdictions around the world that impose tax consequences where a beneficiary that resides there receives an inheritance from a will, out of an estate that's a foreign estate. So you want to determine if there's going to be any type of negative tax consequence by leaving an inheritance to a beneficiary who might be in another jurisdiction. The other thing is that with the U.S. in particular, we caution against appointing executors who are U.S. residents or U.S. citizens, because they have certain certain disclosure obligations and reporting to the IRS. As well, we caution against appointing a U.S. person as the attorney for property under a power of attorney for property of someone that's in Ontario, because there has been some issues we've come across where financial institutions are hesitant to open investment accounts for people where the attorney is a U.S. person. And again, they also will have certain disclosure obligations to the IRS. So, and practically, it also just, it doesn't really make sense, if you can avoid it. Not sure if Elena, you have any other things you want to mention. I'm still looking at some more questions.
You covered it off very well, and I think we've run out of time. So we should pass it over, but thank you everyone for your questions. They were fabulous and on point as well.
Okay, thank you. And now we have some closing remarks from Sharon Howard-Laird.
Elena and Brittany, thank you so much for sharing such helpful information on a topic that affects us all. And hello, I'm Sharon Hayward-Laird, and I'm the General Counsel at BMO Financial Group. The subject of legacy is important to me and to St. Michael's Hospital Foundation. In fact, I'm co-chairing an upcoming campaign for the foundation that will help St. Michael's establish its own healthcare legacy. St. Michael's is soon to be the only hospital committed to reinventing the patient care experience, not only in Canada, but around the world. It's time for patients and their families to get the care experience they deserve. Faster access to care, customized treatments, and care that's all in one spot. Donor gifts, including those that come from bequests, are key to making that happen. So to all of you who took the time to join us online for our first ever virtual edition of Create Your Legacy, Estate Planning 101, thank you. You asked some great questions. Elena and Brittany have shown us how tax efficient and meaningful it can be to give to a charity as part of your legacy. I hope you'll come away inspired and that you'll examine estate planning in a new light, whether you're considering your first will or updating an existing one. Our deepest thanks to those of you who have included a gift to support the extraordinary work of St. Michael's Hospital and Providence Healthcare. And to all of you who continue to support us year after year, day after day, thank you. If you have any questions about today's event or your charitable bequest plans, don't hesitate to contact Sandra Smith through our foundation website. And a big thanks again for joining us today, and I hope you have a great evening.